For generations, silver has been taught in textbooks and covered in financial media as a commodity, simple in its behavior. Supply and demand, mined output, industrial consumption, and investor interest determine the price. Economists and commentators often illustrate charts showing production levels, jewelry and industrial use, and speculative investment, concluding that prices rise when demand exceeds supply and fall when mines ramp up or interest wanes. Yet this conventional explanation is incomplete. The reality of silver pricing, particularly at extreme highs and lows, reveals forces operating beneath the surface, largely invisible to casual observers. Consider this. During periods of intense price movement, there are times when supply appears stable, demand remains robust, yet prices stall, reverse, or collapse dramatically. These price moves seem to defy the textbook explanation. How can a commodity that is physically abundant or steadily demanded experience sudden peaks or crashes? The answer does not lie in industrial demand or mining output alone. Instead, it resides in the financial mechanics underpinning silver trading, the COMEX futures market, leverage, margin rules, and the concentration of positions. These elements create an environment where arithmetic, not sentiment, constrains price behavior. To understand silver price behavior fully, we must first acknowledge the complex infrastructure supporting the market. Futures contracts, which dominate trading activity, are not simply a speculative tool. They are the mechanism through which the majority of silver price formation occurs. On COMEX, the primary U.S. futures exchange for silver, standard contracts represent 5,000 troy ounces of silver. Microcontracts, smaller in size at 1,000 ounces, allow traders with less capital to participate, but are still fully deliverable in physical metal if held to expiration. Each contract is legally binding, and obligations must be met at settlement or through offsetting positions. These contracts are highly leveraged. Traders are required to post only a fraction of the total notional value as margin. Historically, this could be as low as 10 to 15%. For instance, a 5,000-ounce contract priced at $25 per ounce represents $125,000 in underlying value. A trader might post only $2,500 to enter the position. This leverage allows enormous market exposure relative to the capital at risk, but it also introduces mechanical vulnerabilities into the system. Every trader operating with leverage faces a threshold. If prices move against them, margin calls require additional capital, or positions are liquidated. When many traders are leveraged in the same direction, the system approaches a tipping point where small moves can cascade into rapid, self-reinforcing price changes. To see the hidden pressures within the silver market, we must examine leverage, margin rules, and concentration of positions more closely. Leverage multiplies both gains and losses. A 10% price change in silver can translate to a 100% gain or loss on a highly leveraged position. This amplification creates stress within the market, even without changes in physical supply or demand. Large leveraged positions are inherently fragile. Any adverse movement can force liquidation, which in turn moves the market further, triggering additional margin calls. COMEX sets initial and maintenance margin levels for all futures contracts. Initial margin is the collateral required to open a position, while maintenance margin is the minimum that must remain to avoid liquidation. If the market moves against a trader, the exchange issues a margin call. These rules are not static. Exchanges adjust them based on volatility, market concentration, and risk exposure. When prices surge or drop rapidly, COMEX has historically increased margins to reduce risk, forcing leveraged traders to either post additional funds or exit positions. This process acts as a mechanical brake on extreme price moves, regardless of underlying physical supply. Open interest, the total number of outstanding futures contracts, reveals the extent to which positions are concentrated. Large institutional traders, hedge funds, and banks often hold a significant share of these contracts. When positions are concentrated, price behavior becomes highly sensitive to the actions of a few players. The leverage and margin system ensures that stress in a few accounts can propagate throughout the market, creating systemic effects. Historical records show that during extreme price episodes, concentrated positions often precede rapid market reversals. This was evident in 1980 and remains a factor in modern trading, illustrating that systemic vulnerabilities, not supply shocks, often drive extreme moves. At the core of the silver market, S volatility lies a mathematical reality. Leverage plus margin equals an inevitable limit to sustainable prices. Every leveraged position is bounded by collateral requirements. Exceeding these limits triggers forced liquidation. This is a simple arithmetic rule, yet its implications are profound. The Hunt brothers, starting in the late 1970s, accumulated an enormous silver position. Prices rose from around $6 per ounce in early 1979 to nearly $50 by January 1980. Initially, the surge seemed unstoppable. Yet the system itself contained the seeds of collapse. COMEX, concerned with excessive speculation and systemic risk, increased margin requirements dramatically. This forced the Hunts and other leveraged traders to reduce exposure. Positions were liquidated and prices plummeted to below $10 per ounce within weeks. Here, the market did not fail because demand collapsed or mines suddenly flooded the market. It failed because leverage magnified exposure beyond the structural limits set by margin rules. The collapse was a direct consequence of arithmetic, not sentiment. Even today, margin rules act as ceilings and floors for price behavior. When front-month silver margins rise, extreme leverage positions are curtailed. When margins are reduced, traders can assume greater risk. These adjustments create invisible boundaries for price formation, which often explain price behavior better than supply-demand models alone. In financial narratives, crashes or sudden spikes are often attributed to headlines, public panic, or geopolitical events. In the case of silver, these events are rarely the root cause. They serve as triggers, releasing pressure built up by leverage and margin mechanics. Margin hikes, forced liquidations, and position reductions are typically implemented quietly, yet their effect is immediate and visible in market prices. For example, during 1980, the margin adjustments that forced liquidation coincided with heavy media coverage, which framed the public perception as a sudden collapse. In reality, the system had been approaching its arithmetic limits for weeks. The public trigger, media, rumors, or sudden trades, merely accelerated an inevitable mechanical outcome. This pattern is recurring. The market builds stress under the surface, the public sees a trigger, and the visible price movement occurs almost as a byproduct of the underlying financial mechanics. When leverage positions are liquidated, the losses do not disappear. They are transferred across the financial system. Balance sheets reveal that banks, clearinghouses, and large funds are directly impacted by margin calls and liquidations. These institutions absorb some losses while redistributing risk to counterparties. During the 1980 episode, the forced liquidation of the Hunt brothers' positions redistributed risk to major banks and clearinghouses. While these institutions had the capacity to absorb shocks, the episode illustrates how private bets on silver can create systemic exposure even when the physical market remains stable. Modern records show similar dynamics. Highly leveraged positions concentrate risk, and exchanges' margin policies act as a regulator, transferring exposure across the system when thresholds are breached. After extreme events, power often consolidates with those able to withstand margin demands. Well-capitalized institutions, exchanges, and clearinghouses emerge stronger while overextended players exit. This is not speculation. Historical records show that after 1980, major institutions with robust collateral and operational capacity gained greater influence over the silver market. Margin rules codified these advantages, creating structural hierarchies that persist today. The mechanism is clear. Leverage amplifies risk, margin rules constrain behavior, and the system's enforcement ensures that control shifts toward the most structurally resilient participants. Across decades, the same patterns recur. When prices approach extremes, leverage, margin rules, and position concentration dictate outcomes. Open interest, margin adjustments, and liquidation events repeatedly shape silver prices, often independent of physical supply or industrial demand. Even in modern markets, COMEX adjustments, raising or lowering margins, enforcing position limits, continue to define feasible price ranges. The system behaves predictably, if not intuitively, creating mechanical ceilings and floors that the public may misattribute to external shocks. The recurring pattern is instructive. Financial arithmetic, not headlines, governs extremes. Understanding this, the history of silver price behavior appears less mysterious and more inevitable. Silver is a market governed by rules and constraints, not simply supply and demand. Leverage amplifies exposure, margin rules constrain excesses, public triggers release accumulated pressure, and power consolidates with those able to withstand systemic stress. These forces repeat across decades, shaping the path of silver quietly but powerfully. Understanding this structure alters our interpretation of historical price movements. What appears to be chaotic or driven by sentiment is often the predictable outcome of financial mechanics. Once the system is understood, the story of silver is no longer a tale of speculation or panic. It is a narrative of arithmetic, leverage, and institutional dynamics, a recurring pattern that continues quietly in the background of every price chart.